Okay, thank you, everyone. Thank you, Mitch. That was a great introduction. I think rolls really well into what this great panel here is going to speak about. It's an honor to have one of the first panels up here, and a pleasure to be up here with some names in the industry. Just some background: Guy Barutin, Managing Director, Investment Banking at Chardon. Guy is part of Chardon's investment banking group. Joined Chardon 7 years ago to support the team that's been doing the SPACs since 2004. He joined after 11 years as part of the SPAC sponsor group at Terrapin Partners, and group that closed 3 large SPACs between 2007 and 2019. Dmitry Ginov, Managing Director, SPAC President, Brookline Capital Markets. Dmitry's focused on SPACs, IPO, structured financing, and private-to-public transactions. More than 3 decades of experience across investment banking, advising companies, sponsors, and institutional investors. Prior to Brookline, Dmitry was a portfolio manager at Balasini Asset Management and Magnetar Capital, where he focused on SPACs, PIPEs, mergers, spin-offs, restructurings, and other special situations. He also writes the SPAC and Forth newsletter, focused on SPAC market trends, the evolving role of SPACs as a specialized pathway to public markets. Morris Zarif, Managing Partner, Zarif Law Group. Morris is the founding managing partner of Zarif Law Group and is a securities and transactional firm based in New York and New Jersey, focused on capital markets, M&A transactions for public companies, with an emphasis on SPAC formation and de-SPAC business combinations. And last but not least, Brandon Sun, Managing Director, Head of SPAC Investment Banking at Cohen & Company. Brandon is the head SPAC Investment Banking at Cohen & Company. Over the course of 14 years in investment banking, Brandon has completed more than 130 SPAC IPOs, including 31 last year, and more importantly, closed over 140 de-SPACs, including 73 the last 3 years, in every sector and geography. He prides himself on being a trusted advisor and has served as a sell-side M&A banker to some of the most prominent de-SPACs in the past few years, including Xanadu, USA Rare Earth, Webull, and Terra Quantum, who will be presenting at the conference as well. Setting the stage, Dmitry, we'll start with you. Where do you see SPACs still remaining competitive as a path to the public markets?
Thank you, Joe. I think where SPACs have an advantage over the traditional IPO, where there is complexity. In many ways, SPACs are kind of viewed as the special case IPO. And what I mean by special case is, some type of transactions where, like spin-offs or companies going through a restructuring or international uplisting, where the traditional IPO is not well equipped. Another area where I think SPACs are particularly competitive is, again, stories that are a bit more complex. We've seen in the last couple of years companies coming out of like the hard tech industry, such as quantum, nuclear, defense, AI infrastructure. It's very hard to tell a story on the road for a couple of weeks. You need longer marketing, you need more patient capital, potentially structured capital. And that's where sort of SPACs are, particularly useful. So complexity is an opportunity for SPACs, and that's where I think they thrive probably the best.
Guy, same question to you, Guy.
I think SPACs are a solution for everybody else. If you're not Spotify and you're not a household name and can't do a direct listing that's be popular around the world, and if you're not OpenAI or SpaceX, if you're everybody else, and you want some degree of certainty, it's the way to go public. If you're truly considering a public listing and putting the infrastructure in place, and in the case of SPACs, have a dedicated or committed investor base, a small group of enthusiastic investors is what the hot sectors have now. That's why they're hot sectors. But it's I would say, preferred path to public markets for everybody else other than household names.
Brandon?
Yeah, no, I think we live in a very interesting world where a couple sectors are being disrupted. There's a massive public-private arbitrage where the public multiples are so much higher than that of the private, right? Demand is so much higher if you were simply public and can capture not just institutional demand, but retail demand. SPACs, in my mind, represent the path of self-determination for a lot of these targets, right? Instead of waiting for a bank to take you IPO, instead of kind of putting your fate, right, at the hands of various externalities, right, whether it's the market or other things, you could choose to go public through a SPAC and really, really accelerate that trajectory. You're pretty much guaranteed a NASDAQ or an OSC listing, right, if you fulfill their listing requirements. You can control speed, valuation, a lot of things. So I think in this world where so many hundreds of companies trying to go public, right? SPACs offer an accelerated path, and I think it's a path of self-empowerment for a lot of these companies.
Just before we came up here, Mitch mentioned a couple changes since the last cycle. I know from an audit standpoint, we've seen a lot of changes where it's derivative accounting that's changed for certain instruments. Dimitri, what have you seen from your position? What have you seen change since the last cycle? What's significant?
Well, there's been definitely a few changes since the last cycle, and the last cycle is sort of what we experienced from 2020 to 2023. I think a lot of the changes that we're seeing are for the better. If you look at the data, the last 15 de-SPACs, the average price is $10.60, which is probably the highest in a long time. And the reason for that are kind of threefold. You know, one, the quality of the companies that are going public are better. Kind of the days of PowerPoint to NASDAQ are probably, gone. We're seeing companies with real revenues, real management teams, public ready, strong balance sheet. So that's certainly helping. We're seeing, after, SPACs have existed for at least a couple of decades, we're seeing sponsors that have done multiple vehicles. Experienced sponsors are having an easier time raising capital, finding the transaction, funding the transaction. So that helps. Experience helps. And also the pipe market has gotten better. If you think about the bottom of the last cycle, 23, there was about 600 million that was raised in the pipe market. Last year was 6 billion, so it's 10x. And I'll probably bet that this year will be higher. So, so we're seeing better companies, we're seeing more experienced sponsors, and we're seeing capital markets and pipe markets that are more open to funding these deals.
I mean, that absolutely agree with what you just said, and I would just add that what I've seen in my deal flow, and obviously I'm on a little bit different of a side than the other gentlemen on this panel, but what has been driving it for my deal flow on the SPAC side, especially on the targets, is that these targets are more asset heavy. Gone are the days where it's a speculative business venture that these SPACs are trying to merge with. And now with the AI data center play, the nuclear energy play, we are now in a space where targets are rolling up very heavy and high value assets as opposed to a speculative business venture that may or may not pan out in 12 to 18 months.
I was going to say that points out that SPAC is an incredibly complex set of statistics. What we heard before from Mitch about averages, you really have to take that into account. Some of the popular high-profile names are attracting people who put a very high value on the stock. The expansion of the pipe market is both good and bad. The majority of that, the new pipe market, are structured so they're repricing the merger. So the averages blow everything out of proportion. The fact that there are fewer redemptions in the last, X transactions may mean that those are asset-heavy deals with a fundamental set of buyers, as opposed to some of the sectors that are more speculative, that quantum software that may be a few years out for commercialization, or some of the things that Brandon talked about. So you got to be really careful about the averages. But for example, last summer, SPACs were used heavily for digital asset treasury strategies. And there were some deals with almost no redemptions. That skews some of the last year's data. Those are very different transactions than the kind of fundamental deals that we're talking about. So all I'm saying is that this is a structure that you can rely on to get public if you're working with the right advisors and attorneys and accountants. But it's still an avenue for something more speculative to get out there too. It can be engaging for both kinds of deals.
Yeah, that's really good information. Now that we've kind of set that table, let's talk about where some of the opportunity is. So I guess, Dimitri, we'll start with you again. What sectors do you think are best positioned for SPAC activity over the next few years?
I mean, we already discussed, I think, sectors that have strong secular tailwinds behind them, sectors that don't really depend on the economic cycle. We're going through this unprecedented AI infrastructure build out, so anything that supports that has been in favor, and we've mentioned those, the nuclear, the data infrastructure. Defense obviously is in its own secular trend as well. So these are some of the sectors which I think investors like. The government is very supportive. We're seeing the government getting involved in some of these sectors because it finds them very strategically important. So these are the sectors where you can, count on sort of more investor following than others. Outside of just purely sectors, because of my background, kind of being a long-term special situation investor, I kind of like opportunities that are undiscovered, and two areas which we haven't seen a lot of examples of, but I think will probably get exciting, one is kind of post-reorg equities. I think if we get into potential cycle in private credit, we have more distressed. There'll be some very interesting companies where, the balance sheet will be cleaned up, probably good businesses, but the investor base will be very unnatural, kind of being debt holders. So that could potentially, there's been a couple of examples, and I know people have tried it, but that could potentially be something very fertile. Another area which I find very exciting, I've been pushed a lot of sponsors to kind of get involved in that, is income producing sort of assets. We've seen some interesting SPACs that have done very well. There's a lot of demand for kind of income yielding opportunities. There's been a couple of SPACs that are very successful in the oil and gas, in the mortgage REIT space. So these are kind of two more structured opportunities outside of the sector, which I think are interesting. Again, sort of complexity is something unique. Strong secular tailwinds is what I think helps in the SPAC execution.
Anybody else?
Yeah, so in terms of the last couple of years, where we've been spending the most amount of time on is a couple of sectors, right? Rare earth and critical materials. That's probably one of the hottest sectors out there. There's 6 rare earth companies that have gone public in the last few years, all through SPACs, and we advised 5 of them, right? Quantum computing is another one of these sectors, right? 9 companies, up until last week, Quantinuum's IPO, 9 companies have gone public through SPACs in quantum computing. Every single one of those 9 trades above $10 per share, right? Anytime you have one of these sectors that's effectively being disrupted, right? Whether it's SMR nuclear, quantum, and I think soon to be space and satellite, right? It forces companies, shareholders, management teams, right, to explore the SPAC path, because it's effectively the highest valuation, it's effectively the cheapest cost of capital, right? It's effectively the broadest base of capital. So if I'm a steward of the management team, I have to explore go public, right? I could do an IPO, but honestly, it could take too long, right? And I think it forces every single one of these companies to evaluate a SPAC. I think on a go-forward basis, there's a couple of sectors we're really bullish on. We like robotics, we like AI, autonomous. Critical materials continues to be hot. Quantum computing, deep tech will be good. Defense tech, I think, will be a space to focus on. So I think next year will be really exciting for the SPAC markets.
There's a very small sector still doing biotech SPACs as well. There's a handful of very experienced sponsors that have gone out. They're the only ones with no warrant structures, or so it's a small but still interesting sector for SPACs.
There's also, from my perspective at least, the opportunities for entrepreneurs out there looking to do roll-up transactions. You know, if you identify a specific sector that you have expertise in, gathering, for instance, in, again, the AI data centers, just because it's the easiest example, gathering various assets within that space and rolling it up into a SPAC, into one entity is also a great opportunity.
Yeah, so that moves nicely into our next couple questions. We are talking about sector, but also quality of targets and different types of de-SPAC transactions. So are there any specific types of transactions that you're seeing that are more investor friendly or investors are looking forward to versus any others?
In terms of investor friendly, again, let's if you've got an unusual story or an out of favor sector, but you have friendly investors, I would say that's the ideal situation for the complex, unusual story. That used to be the prime reason for a SPAC. We, years ago, worked on a dredging company or a paper company, companies that aren't typically going public. If they have a group of investors that wants to back that sponsor or that thesis, that unusual off-the-run ideas would be attractive to a small but dedicated group of investors. That's a perfect section for a SPAC. But no, there's not one sector. It's all about pricing the merger properly to get the investors. One of the things Mitch said before is the SPAC pipe market has boomed. It's 10 times bigger than it was. 95% of that are structured investors who are resetting the price, which is great. But the ones that trade well are the ones that are pricing those pipes not at a discount to the trading value, but at a premium, and that's a very small number, and you've worked on some of those. So again, the small dedicated group of investors who find that valuation friendly are what powers a pipe. I mean, a SPAC.
Yeah, well, what I would add, I agree with what Guy was saying, but what I would add is that, a SPAC naturally comes with a lot of friction costs. There's promote, there's fees. So to the extent the target has, opportunities to create value and to offset that friction cost, I think that's very valuable and interesting. And so that kind of basically leads us to companies that have, at an inflection point. And what creates an inflection, a company that is pre-profitability and turning from loss-making to profitable, that's clearly an inflection point, revenue ramping up, operating leverage. A company that is getting its balance sheet fixed, that's an inflection point. A company that maybe has a product that is, going from a pilot to something proven with real revenues, contracts, that's an inflection point. Management change, a change in the industry. So any of these inflection points create a lot of value, and if you're able to strike a deal before that inflection, that's obviously very interesting, very valuable, and can offset a lot of the potential costs that a SPAC can bring. So that's something interesting. And another interesting that we're seeing, and Brand mentioned some of the quantum deals and some of the nuclear deals, they're coming out of international markets. There's a big sort of US to global arbitrage in terms of multiples. US market obviously trading much higher. Also, the funding markets in Europe and potentially Asia are a lot less developed. That's why a company that actually reaches the level of being public ready has much stronger DNA because they had to survive a much more difficult market. And that's why we're seeing companies that come out of Europe, Nucleo, some of the quantum deals, that have traded better and done better. Actually, if you look at international listing, on an average, they've actually done better than some of the U.S. counterparts. So that's another area that potentially I think is interesting.
So Guy, going back to you for a second, we talked a little bit about the sector, but does it really matter if the anchor investment and capital market experience is there? As long as the anchor investment, pipe investment, that's really what matters the most.
Yeah, it could be a boring, slow and steady business, but if the control investors want it to be traded publicly and they're willing to put the core capital in, it's not an IPO where you're reliant on a book being built. You can make your own book. So it doesn't matter what sector. What matters is the right valuation for a core group of investors who want to support the stock. That's why I say it's an IPO for everyone else. But the folks who are saying, we all get these calls, if somebody wants to raise $100 million, go find me a SPAC with $100 million in it, are missing the point. It doesn't matter whether you're the hottest sector or not if there aren't supportive anchor investors. So yeah, absolutely there are hot sectors that have lots of investor demand. But for everyone else, maybe I'm a voice in the wilderness, but I don't think the sector matters at all. What matters is that you're appealing to the right group of investors who at the right value. So I'm a big fan of the structure regardless of the sector.
Sorry, if I can add to that, I totally agree. I think the sector gets you in the door. The sector is probably attract more investor attention. But I agree with Guy, I would take a company that is in an unsexy business, but it's well-funded versus a company that's in a very hot business that is not capitalized properly. I think the sector gets you in, it's a necessary condition, is not sufficient. You need capital, you need execution, you need experience to be able to close it.
Okay.
I also think
I was going to add in as well. I think in terms of pipe investors too, right? I agree with Guy and Dimitri and everything they said, right? Pipe investors also want to support companies at points of inflection, right? Where they're going to massively accelerate. So for example, we took a company called USA Rare Earth public, right? We were sell-side advisors. They were, at the time, a smaller, earlier stage rare earth company. Since going public, they've grown from a $1 billion company to a $7 billion company. Since going public 15 months ago, they've raised $5 billion $5 billion of capital in the public markets, right? Capital was there to support USA Rare Earth at every single inflection point, whether it's a key acquisition, right? Whether it's a big strategic initiative, right? And I think the diversity of capital is also important. It's not just retail capital that bid up the stock. Institutional capital came in for the pipe. Government capital came in to support the company at critical junctures, right? I think that's what's exciting about the public markets, right? If you can go public, take control and destiny, right? The world's your oyster. There's a ton of access, right, from various sources out there.
I was just going to add, I think what Guy said relating to having a core group of investors is also extremely important for the post-DSPAC company. From structuring the DSPAC merger to having a company that is public company ready that won't sink to the bottom the second they get listed on NASDAQ or NYSE. It really does depend on the core group that's behind it. And we've seen, or I've seen, and maybe you guys can talk about your experience, the structures of these de-SPACs having longer and longer lockups and leakouts for that specific reason. They have a core investor group that is okay agreeing to staying in the SPAC stock for 18 to 24 months post de-SPAC.
That's because they have a set of catalysts that we're talking about, that it's a signal to the market. It's intellectually, they know something is coming. It's not public. And they're willing to sign longer lockups. It's a signal to say we've got catalysts coming. It's exactly right. And you raise capital at the right value at the right inflection point. It's a classic use of the public markets, just like Brendan's saying. But if you've got an unusual story, it's the opposite of going public and then failing on your first couple of quarters. If you take advantage of a SPAC by getting public at the beginning of a set of catalysts and then have those catalysts announced, then your core shareholders aren't leaving money on the table by going public and then selling out later on. You can structure the SPAC so they can get, it's called earnouts, but it should be called earn-ins. It's the wrong name. But the right group of investors at the right value, backed by the positive catalysts going forward. It should be a totally managed process. Unfortunately, it's not uniformly well managed, which leads to the decline in value. But as Mitch said, if you have 100% redemptions and reprice through some structure at $5, but then have a series of catalysts, then everybody who cashed out is fine. They got their money back in redemption. The new pipe people who came in at 5 are seeing the stock grow. It's the definition of a win-win. But the statistics, you can be a regulator and say, oh, look, everything's down 50% or 60%, and that doesn't tell the full story. It's a much more nuanced story. But the catalysts and the right investors, so we're all agreeing.
Yeah.
Yeah.
Switching gears a little bit, we're going to talk about some regulation and some economics. Last couple of years or so, we've seen some syndication of sponsor risk capital. Any opinions on that?
I mean, I can start. I think a lot about sort of the promote and the friction costs, and I kind of compare SPACs to private equity and venture capital. You can tell, maybe that's very similar in terms of taking risk and looking to acquire business or merge with businesses. And if you look at the sort of the PE and VC model, there's a lot less downside and kind of similar asymmetric risk. I think something that is rarely spoken is the SPAC sponsors actually take a lot of risk. If you look at the data over the last 15 years, there's been about 454 SPACs that did not find a deal, had to return the capital. They burned about $4 billion of risk capital. So there's clearly a lot of downside. So I'm a proponent of actually distributing that risk to the extent as possible, but it's got to be done in the right way. It's got to be alignment of incentives. It's got to be transparency. And if the co-sponsors can add capital, can add idea, can add execution, can provide market sort of sentiment and color, it can be actually a competitive advantage. So kind of intellectually comparing it to other vehicles like PE, VC, I'm a proponent of that as long as it's structured in the right way.
Look, my view on the risk capital stuff, on the syndication is I think the SPAC sponsor needs to treat the risk capital investors like their own, right? I think the last wave of SPACs back in 2022, were a lot of them liquidated. Unfortunately, look, it was SPAC sponsors that got lazy, right? They said, like, I'd rather not put my own personal reputation, do a bad deal, right? It's someone else's money, I don't care, right? I think a lot of SPAC sponsors lose sight of the fact that, look, they want to do a great deal, but more importantly, they just got to do a deal, right? They have a fiduciary responsibility to risk capital investors. They have a fiduciary responsibility to the public investors who support them, right? Because even if it's not a great deal, the warrants have some value, right? It's also, in some ways, look, respect to service providers that got them to that point, right? If there's a deal, there's a chance for everyone to still kind of get rewarded and to contribute. So I think a lot of SPAC sponsors who completely de-risk, right? Where it's misaligned or they only put in $500,000, they don't have to do a deal. I think that market's unhealthy. So in terms of the way we look at the world, we want to support SPAC sponsors that's going to treat every single one of these risk capital investors as if they were their cousins, as if they were their best friend from college.
That's an incredibly diplomatic answer. I'm really torn, right? The most asked question, at least in the last couple of roadshows that we've run, are what proportion of the risk capital is coming from the sponsor and how much is syndicated? And so I'm competing with other investment banks. We'll raise risk capital, and we do all the time for sponsors. We do it very selectively because we want to be able to tell investors that the sponsor is really aligned and it's not an easy decision for them to liquidate or to do a deal that is not going to, doesn't have all the forward-looking momentum that we want. I'm actually a huge fan of syndication when done right. I think syndication, unfortunately, though, enables a lot of inexperienced sponsors or sponsors who might be lazy. Lazy is not a good word, but who might not be appropriately aligned. And so, to Mitch's point earlier, we're on an upswing and having a lot of IPOs is good for the business. If you're a de-SPAC target, you have a lot of people to choose from. But it does lower the barrier of entry to sponsors. It used to be that you really needed to have a core set of skills. And so what we try to do is syndicate for teams that have all those skills, investment banking skills, M&A, private equity, board of all those things. So it's a mixed bag. You have to syndicate carefully.
Yes. Good advice, good advice. We have about 5 minutes, and I do want to leave time for questions, so we're going to do we have about 3 questions left. We'll do a little rapid round here. The new NASDAQ SPAC listing rules took effect in May of 2026. How are sponsor teams, advisors reacting to these rules in response?
Yeah, so I mean, as everybody here probably already knows, NASDAQ and the SEC have kind of been on a tear this year, kind of acting in like a yin-yang capacity of SEC deregulating, NASDAQ re-regulating. From the SPAC, in the SPAC world, as we all know, NASDAQ raised their standards for entry into the IPO market. The capital markets went from, what was it, 50 to 75. Global went from 75 to 100, with multiple changes to increase thresholds for round lot shareholders, et cetera. So, from a legal perspective, and this is the best kept secret on the law firm side, doesn't impact me very much in terms of how we approach doing an IPO. Again, from the legal side, drafting an S1 from 75 to 100 million is literally a Control F problem. I'm curious to see what it's like on the investment banking side and how you guys are handling that, because obviously these regulations are absolutely making your lives, I don't know, harder? Is it more exciting?
It's a good segue from the sponsor syndication sort of things and working with experienced attorneys. These are all things you just need to plan for far in advance, not the month before you're going to close or the 3 weeks before the shareholder vote. You got to be working with people who are reminding you that the attorneys are about to submit your NASDAQ or New York Stock Exchange application. How many shareholders? You're thinking about these when you're negotiating the BCA. So for us, our checklist got rearranged a little bit. We're moving those things that used to be closing items up to the very beginning of negotiating BCAs, merger agreements. Just another thing, another requirement you have to meet.
Right. I know one of the big items for the auditors and the accountants in the room is de-SPAC ready, right? Do you have PCAOB financial statements? Do you have your accounting in order? Are you ready to be a public company post de-SPAC? A question to everybody, and we'll start from the end and move our way down as we close out. But post combination, a lot of these SPAC companies are facing immediate capital market challenges, whether it's stock price, pressure on redemption heavy, trust depletion, or need for quick follow-on financing. What do you think some of these sponsors and their legal and banking teams should be doing at the deal documentation stage to set the company up for a smoother post-close experience?
It's exactly what Guy just said. It's just preparing and over-preparing prior to closing for either the IPO or the de-SPAC transaction in the BCA stage. Having the S1 for the resale registration, as well as, and God forbid to say this word, the ELOCs that come post de-SPAC, is extremely important. Having the investment bankers on your end aligned with the company on the post-SPAC, on the de-SPAC transaction, ready to start raising funds for future plans. And of course, all of us acting as the quote-unquote gatekeepers and making sure that they have a business plan to act out with the funds that they're actually raising. From the legal side, making sure that the auditors are engaged early, that the communication is always open, that they know that these S1s and S3s and S8s are all coming down the pipeline. That's another thing, making sure your incentive plan is robust enough to initiate hiring and retention for the de-SPAC company. Also really important, getting that S8 out and registering enough shares, not just any incentive plan that comes your way.
I mean, what I would add is that a lot of sponsors kind of think, once the document is ready, the pipe is raised, I'm done, I'm thinking about the next SPAC. And, if done properly, the start is really at the close of the de-SPAC, because, you should be there to help create value. There's an interesting study that was done by the Phoenix Fund that invests in a lot of de-SPACs, and they kind of looked at the cohort of SPACs that kind of close in 22, 23, and the first 2 years they struggle. Stocks kind of trading, under 5, And then they recovered after 2 years because they sold unprofitable assets, they fixed the balance sheet, they became profitable. But it took them 2 years. And so the question is, why not create that path at the closing? So think about the operational improvements that you can create. Don't wait until kind of the market forces you to do these changes. Think proactively, how should I position the company for investors, the cadence of earnings reports, creating value, if we need to rationalize the asset base, cost base, et cetera. That should be sort of thought through in those months that you're preparing the close and create value after that.
Yeah, you got to match up the target that's less well prepared with a SPAC sponsors who's got more capital market experience. That's the banker's job, is to make that the right team. If you're putting an inexperienced team with a sponsor that's going to move on to their next SPAC, that's not a sustainable business model. Investors aren't going to want to come into your next deal. So you've got to match the skill sets together.
Okay, I know we have at least one question.
I wanted to ask the differentiation between an IPO and a SPAC. I assume the IPO is a situation where you have a specific company, it's going public, shares are sold in the market, everybody in this room goes to buy the shares, and they own the shares. They want to liquidate, they sell it on the market. A SPAC, where's the differentiation there? Because the last thing I want is redemption. I can't have redemption.
The equivalent is the de-SPAC. The IPO of a traditional company is equivalent to the de-SPAC transaction of a SPAC, where new investors come in and decide whether they want to invest at that valuation. It's an analogy to building a book in an IPO. The SPAC IPO is a separate transaction.
Is the IPO, is the SPAC transaction a transaction that's similar to any stock transaction that occurs where you're going public, where you're taking a company public? So the SPAC is just a terminology. Is it no different than, like, ABC company is now listed on the NASDAQ? But it was a SPAC, that's how they got there?
Yeah, the day that the de-SPAC closes, the SPAC sponsor hands the keys to the new company, and it's just as if they had done an IPO. They have a different capital structure, perhaps, but that's the analogy.
Yeah, and I think the other difference too is, like, if you look at a traditional IPO, right, it's genetically engineered to trade up. The investment bank simply won't work on it unless it trades up, and they can raise a lot of money and they can scrape a little bit of fee, right? So there's effectively a principal agent problem, right? The banks are trying to get the lowest possible valuation. I think that what's powerful about a SPAC deal, look, it's more of an M&A deal, right? It gives a lot of control to targets, controls to entrepreneurs and founders, right? And I think the other element's speed, right? Like SpaceX is a perfect example. Who knows what happens next week if the SpaceX IPO is not successful, right? The market could lose a lot of wind in its sails. Whereas if you have a great SPAC deal, for example, there was a deal announced yesterday called Quantum Space. Space company, they raised $300 million in committed capital pipe. They're gonna go public and raise $300 million no matter what happens to SpaceX IPO, right? So it also just gives a lot of control back to the target teams.
Hi, everybody. My name is Eliron. I'm the chairman of Ananda Labs. It's a biotech company. And I just had a comment for you guys that you just missed a $20 trillion market, which is going to be the next big thing after AI, and it's the longevity space. Jeff Bezos just invested $3 billion in Altos Labs, Sam Altman $1.2 billion in Retro Biosciences, and Brian Armstrong from Coinbase just raised, like last week, $435 million to his new company, and that's the next big thing. So what I saw is that you actually gave examples of companies that you know that are already went public through SPACs or IPOs, but the things that are coming now in 26, 27, 28 are solutions to cure age-related diseases and diseases that are all related to aging, and by curing the body and the organs, which are actually potential for 8 billion people on the planet. So it's just a comment and just to open the eyes and ears of everybody related longevity. Thank you.
I don't think we see any other questions, so we'll wrap that up there. Thank you, gentlemen. Appreciate it.
Thank you. Thank you.